Welcome back to the channel. Today we're reacting to a video about the future of wealth discussion. Before this video starts, I'd like for you to know that I am not a financial advisor. Also, consider checking out my second YouTube channel. The link will be in the description box below. It's the men's version to this YouTube channel. Help me get this video to 1,000 likes. And as always, don't forget to like, share, watch more videos, and subscribe to the channel.
Advertising and de-risking real estate for wealth building. I'm Joanna Smith Ramani. I'm the co-executive director of the Financial Security Program here at Aspen. And I'm just so excited for today's conversation. We fancy ourselves a little bit of detectives around financial security work, always exploring and digging curiously to figure out what are the real kinds of innovations, the new kinds, the expand your mind kinds that can bring real equitable wealth building in our country right now. And we've been really going asset class by asset class to find the possibilities. Ida and I and the rest of our team have just been so deeply inspired by work that we've been digging into in the last months, really looking at the potential of commercial real estate and mixed use real estate as part of a wealth building strategy. We're also familiar with residential real estate, home ownership as part of it. But what else is there in the asset class of like land and buildings that we own that can do something big in our country? So today we're in for a treat. I am so deeply inspired and excited by the set of speakers we have today. We have researchers, entrepreneurs, innovators, and investors who are really committed to seeing this thing through and making it a reality as a real inclusive wealth building strategy. And that's what today is for. So thank you for joining us. And I'm just going to say, let's get started and dig in. So we have less of the time, which is me babbling, and more of the time with the amazing speakers that we've gathered together here. So I'm going to invite Tracy to turn on your camera. Hello, Tracy. How are you today?
I'm great. It's so good to be here. I'm excited about this event.
Well, thank you. I mean, first of all, I really got to know you and your work this summer around an event we were doing on the potential and possibility for commercial real estate. And I'll admit that I was sort of a lowercase s skeptic walking in, not like I don't understand commercial real estate, but in my world, I'll just be honest, as a asset builder, financial security person, nerd, whatever you want to call me, for the last several decades, this part of the conversation just really hasn't been sort of mainstream in our field, and hasn't been a part of what we consider to be sort of real opportunities. And after getting to know you and your research and learning from the folks that are on the call today, like I'm a full convert in thinking about how this fits really into a whole wealth portfolio, right? A whole set of wealth activities, not just it on its own. But part of the reason, Tracy, I'm so excited you could join us is truly, you're one of the only one of a few researchers in this country even looking at this, right? I think that's true.
It's a little niche.
It, Certainly we want to make it less niche, but it is a little niche. And you guys have the work that you've done at Brookings has the kind of insights that we really need to know to understand the context that this opportunity fits in terms of building more inclusive and expansive wealth opportunities. So I'm just excited for you to share with us kind of what have you been learning, what's on your mind, what will help us have better foundation to get into the nitty gritty of what we do.
And also, let us know in the comments what is it that you know already towards wealth building. That way we can kind of work off each other and build and learn from each other.
Okay, so I made a set of slides
Yeah, you
that
did.
are 7 reasons why
Okay,
this is a good
excellent.
idea. So
Good. We're
I
like
can
doing
I
a
can share
David
them.
Letterman top 10, right? All right.
I'm not gonna like PowerPoint everyone to death. Like let's have a conversation and not like get too married to these slides. But I do have these here,
Okay.
and perhaps we can use these to guide our conversation. Right.
Fantastic.
So like to your first point that uh this is pretty niche. You're right. Like this isn't a part of the conversation because the vast majority of people do not own any commercial real estate, right? This is an asset class that we are just not familiar with. So, what I'm showing here is that even amongst white households, that it's less than 10% of white households that own any commercial, non-residential commercial real estate, right? Because um, commercial real estate is like any income producing asset, and so that can include like apartments for rent.
Okay. Okay.
But I focus on the non-residential stuff, so like offices, warehouses, stores.
Let me know in the comments, are you part of that 3% or that 8%?
And this is a very obscure asset class, but it is also a very big asset class.
Yeah.
And if you look at real estate combined, it's the second most common asset class after cash. So it's more common than stocks and bonds. Both in terms of the number of people who own it and the number of the overall like aggregate dollar value in the class. And it's also something that it's also similar to cash in that it's like it's tangible.
Yeah.
You can touch it. You can see it.
A physical asset. Yeah.
Yeah. And so that means something different to people than other asset classes that are more abstract.
Tracy, can I ask you a question? One of the things I'll say, one of my kind of, it's not really a misunderstanding so much as a small way of thinking about this, when we were first learning about this earlier in 2023, was that when I think of commercial real estate, I work in downtown DC. So I think of like class A, class B office space, right? That
Sure.
Right now, because of the changing ways we work post pandemic, just doesn't feel like a particularly, like it is an investment that has some fragility, right? That people aren't totally sure about. But the work here and the work we're talking about today and the work you're concerned about isn't really, maybe it includes that, I'm not sure, but it isn't really that. So can you
It's
just,
not, right?
yeah,
So like,
what this
yeah,
is talking
we're
about?
not going to democratize office building ownership, right? Like kind of downtown trophy office space
Yeah.
is like at one extreme end of the CRE spectrum, right? You're talking about prior to the pandemic, assets that are like the single highest dollar value per square foot of any real estate asset.
Okay.
And frankly, like the trophy stuff is still quite valuable post COVID, and demand for that remains strong. So, like, while there is this, like, shaking happening in the office market because of what's going on with the BNC space, these remain multi-million dollar assets, right? And the challenge there is different because figuring out what to do about it is in part so hard because of how many multi-millions we're talking about. That have to move around the asset. But at the other end of the spectrum are there are far more smaller and more accessible assets that are the ones that are literally closer to home.
Yeah.
So in my research, I am focused on democratizing commercial real estate. I'm focused on neighborhood retail, which
Yeah.
is that's something that we can all reach out and see and touch.
Yeah. And that, I mean, there have been changes to how we get our stuff, but dentist offices, hair salons, like picking up your pharmacy, like these things largely need to be in person near you, right? So it's a different demand for the space and use for the space than necessarily a person like me that can work virtually.
So, I want to be clear that like retail is also going through a huge disruption right now, right? It's not just like office spaces that have been challenged by the pandemic. The challenge for retail is predates the pandemic, right? And is related to how logistics is changing, but also like how consumers prefer to shop, the rise of social media, the rise of the experience economy. There's like all this stuff that is really motivating a big like moment of innovation in retail business models.
Interesting. Okay.
So but what has been harder is that you can change a business model much faster than the built environment
Yeah.
changes. So we have all these new kinds of businesses and all these new ways of doing business trying to fit themselves into the same old stores. That
Yeah.
has led some people to conclude that stores are obsolete, that brick and mortar is over, we're just going to shop online. But that's not true, right? Like The issue is just that brick and mortar it's difficult, costly, slow to adapt.
That makes total sense.
Different challenge.
Yeah.
And an issue that disproportionately impacts Black and brown neighborhoods, because in places where access to capital is more challenging, that makes it even more challenging for the built environment to adapt.
The change in
And
the
so
yeah.
you have a paradox where what we saw during the pandemic was this incredible burst of entrepreneurial energy coming out, especially from Black and brown communities, where many workers, essential workers in leisure and hospitality, were terribly impacted by the pandemic and lost their jobs, but had great new ideas that they, had nothing left to lose and some time and space to potentially pursue. So
Yeah.
there's all this entrepreneurial energy, and it needs somewhere to go.
Huh. Very interesting. Well, let's move then to your number 2 point, which, may be related. But specifically talking about kind of retail redlining and some of the other kind of equity issues in our country around actual real estate.
Yeah. So I think, when you come to the racial wealth gap conversation, you come to it motivated by caring about communities of color, the households and families within them, and their ability to thrive. And, what I'm observing here is that this is, for me, it's not just about wealth building, that it's important that people and places just have what they need.
Yeah, of course.
And there are huge disparities in terms of access to retail across neighborhoods in the United States. This is a missed market opportunity for retailers of all races.
Yeah.
But it's also and speaks to like the how there's a need to unlock the potential of Black entrepreneurship, and enable it to thrive. Like, that would benefit not just Black entrepreneurs, but Black neighborhoods, Black communities, the Black workforce. And doing all of those things would address the racial wealth gap in a really meaningful way. But this is something that I think there's also just like a needs-based case to address, that like everybody wants to, people want to live where they can access stuff.
That's right. That's right. Well, and in our work, and then we can move on to this, to the points you're making, which I really appreciate, that this is not just about the way the ownership of the commercial real estate might change your balance sheet, but the other kind of really important impact that it has, which is sort of what we're walking through.
This is like the placemaking case
Yes,
for
exactly.
democratizing CRE, that like
Yeah.
the market alone is delivering us this result. Ta-da.
Yeah. Well,
So
and I
we need
think
to do something different.
Yeah, and I think about our work on just what are the functions of wealth, and there is a financial function of wealth, obviously, and especially in our country, the way it's set up. But there are other pieces that are actually about kind of the dignity and quality of life that wealth brings. And I think that's intersecting here with, where do people live and can they get the things that they need,
Right.
and the things that they want. So
Yeah.
let's move into the next thing, which is so interesting. And it is the fun intersection for all of our homeownership folks on the call, people that are into residential real estate, the intersection between commercial real estate and residential real estate.
Yeah, right. So like this is like where I get really passionate.
Yeah.
Because I think that the placemaking case isn't just like a cute case that's about like feeling good, meeting needs, right? This is also just like, this is like a basic nuts and bolts fiscal case for why we need to care about neighborhood retail and start doing it differently, because it's an input to home prices, and we will never stabilize home values and fully address equitable valuation of homes in Black neighborhoods until we get this retail piece right too, because it is such an important factor in people's willingness to pay for a home. So, this is important to resale value.
Yeah. And do you think this particular point let me think about how to ask this question, is like maybe it is well understood in the community development and economic development space, but maybe it's just that residential housers aren't working directly with commercial real estate folks, or like what do you, is there a piece that's missing about how people understand this point that keeps leading us to maybe only invest in sort of down payment assistance or things related to housing, but not related to commercial side?
Yeah, I mean, like we are siloed.
Yeah.
Right? Community development, economic development, placemaking, and planning. Those disciplines are all really siloed. They speak different languages. They rarely talk to each other. And it's not just like an absence of communication. There's often like active distrust between players across these different sectors. And so there are, it's not just a vacuum, but like active barriers to working together. And so, yes, like what I'm talking about is like a lack of an integrated, holistic practice that is about making great places. Like we here at Brookings, we call this transformative placemaking, right? Like the idea that those four sectors can work together to solve shared problems.
Yeah. Okay. Thank you. I really appreciate that. Let's definitely spend a little time on number 4 and then see if I can manage our time well enough to mention the last ones, but I wanted to make sure we hit on these 4 with some amount of time.
Right. So here we are at the fiscal case again, which is that I am a homeowner myself. I'm not trying to say that like I don't think homeownership is important, but I think that there is a structural challenge in majority Black communities, majority Black jurisdictions, where the underdevelopment and the devaluation of the commercial real estate tax base puts extra pressure on the residential tax base and creates a negative and self-reinforcing cycle of a paradox of undervaluation and overassessment that is contributing to the racial wealth gap, but this is like a structural and cyclical and reinforcing thing that has to be addressed through the kind of holistic and integrated economic development that's just different from the conventional practice. And so, what I'm showing on this graph is that this is just, yet again, here's why no one is thinking about commercial real estate, okay? Because it's tiny, right? So if you think about the built environment, most of it's housing, right? Like over 90% of it.
Yeah.
And that little orange sliver at the top is all commercial real estate. So some
all the places we go
of that is stores.
We're not in our home. That's where we go.
So it's like, yeah, it's just like, duh, no wonder. No, it's totally reasonable that no one is thinking about this. Yeah. Except that what I'm showing in the other bar is we got to wake up and start thinking about this in part because these assets are scarcer, that their value on a dollar per square foot basis is enormous. And so even though what we found in our research at Brookings is that the devaluation of commercial real estate in majority Black neighborhoods is less than housing. Housing is like 23% devalued, and commercial real estate only 7%. You think, oh, 7%, man, I have enough problems.
Right.
Do I really need to worry about this 7%? Well,
tell me in the comments, why do you think that is?
Well, you do, because it works out to almost half of the aggregate devaluation loss in majority Black neighborhoods.
Yeah, I mean, this is substantive amounts of wealth loss and money not being, captured and then reused. So we just have a few more minutes before we get you. What I'm so excited about how you've set up is that knowing the folks that are coming on board to talk with Ida, some of them are thinking more about this integration that you're talking about and are really working to solve these siloed problems and have more of a, what was the phrase you used that Brookings used? I love it.
Integrated?
No,
holistic, transformative placemaking.
Transformative. I was like, no, it's a powerhouse word, Tracy. Yeah. The transformative impact.
Yeah, that's our $1 billion word.
Yes, I love it. So we want to make sure we get to the transformative innovators that are coming after us. But do you want to just briefly walk through in a couple minutes, really, the headlines from the other parts, and folks can really find.
Yeah, you have other speakers who are going to speak to these things better. But so why democratize? Right, is a big question that we're going to talk about today, right? So like, why not just like, invest more in CRE? Why does it also have to be different? Yeah. It's because We know that neighborhood revitalization is going to take a thicker capital stack, and a democratic capital stack is one way to raise that.
Yeah.
We have tried CDFIing our way out of this problem, and this is not to say that CDFIs have not had a tremendous and positive impact, but we need all hands on deck in terms of sources of capital in order to do something about this.
Makes sense.
So, that's something that I think, you have other speakers today who are going to put dollars and cents on.
Yeah.
And then, there's also this interest in the wealth building space in tangible investment products.
Right, as you mentioned.
I think I don't want to get like too spicy, in when we don't have time to get into this, but I think like one of the things we learned from the popularity of crypto is that there is enormous demand out there for alternative investment assets.
Yeah.
And that ones that are not credible and that do not have a real value proposition will continue to have traction as long as there aren't vetted, de-risked, tangible options out there for communities that have real reasons why it's not enough to just be like stocks and bonds.
Right. That's exactly right. Such an important
this
point.
demand is real. We can meet it legitimately, or we can meet it illegitimately. Those are the two choices. There is not a third choice.
Yeah. Thank you, Tracy. What an important point. And then this last one that I think, again, is important because of the holistic approach that we're talking about here.
Yeah. So this is transformative placemaking, right? That like, this is the need to overcome place challenges is going to take all hands on deck from all these sectors. And real estate is where a lot of this comes together. And, we're not going to be able to charity our way out of the challenges that the communities we care about are facing. And we need to inventory the assets that we already have, that are already in these neighborhoods, and we need to retain and leverage their value in order to transform these neighborhoods instead of just allowing that wealth to be extracted.
What a great place to end here and go into Ida's conversation. And I really do love and appreciate the point of viewing all of these neighborhoods as, the people are assets, these physical structures are assets. And instead of kind of extraction wealth policies that we have been using, what are the ways
Yes, ma'am.
Physical assets become actual assets for the people that are in that neighborhood and in that community too. Tracy, awesome. Thank you so much. Again, everyone can go deeper into her research there, but your ability to Reader's Digest for us was beautiful, and we are grateful for it. And you and I are going to pop off the screen, and I'm going to turn it over to Ida for the rest of the conversation. Thank you.
All right. Thank you so much, Joe. And thank you, Tracy. And hopefully you guys don't go too far, because as I call on the other speakers and we have a conversation, there may be ways that we just want to really, up the ante and bring you back in and join us. So hopefully you'll stay on with us in the background. Everybody, just for those of you who don't know me, I'm Ida Rademacher. I co-lead the financial security program with Joanna. And the conversation about the future of wealth has been a long time coming at the Aspen Institute. We've been, some of the folks that I'll introduce here in a second, joined us for some of our first real conversations about how do you reimagine this field and what its goals are back in 2017 and 2018 out in Aspen for some of our early workshops. And it's really blossomed as we've published the new wealth agenda. And as Joe said, we're excited to be diving deep asset class by asset class on exploring what are the opportunities to really fully create a continuum of ownership and investment opportunities to think about wealth as a fundamental piece of the puzzle for financial well-being for more households in America. So let me call on the practitioners, the investors, a set of folks who are going to really dig into some of that kind of case making that Tracy made and help us bring that forward. So Talib and Tracy and John, if you could bring on camera. Hi, welcome. And let me just say a little bit about everybody here. So John Haines is the founding executive director of Community Investment Trust, which we'll hear a lot about out in Portland, but really happening, lots of interest across the country in that, John, and I'm grateful that you can be here. Talib Graves-Manns is one of the co-founders and the managing partner of Partners in Equity, which I'm excited. I don't know that as many people in our conversation today are familiar with your model, and so excited to have that as well. And Erika Wright is the vice president at the JP Morgan Chase Foundation and the Learning and Insights community there, and JP Morgan Chase Philanthropy. One of the real kind of serious learners and investors in the potential of commercial real estate and of shared ownership in particular in those areas. And so we wanted to start to have a conversation across both practitioners and investors in some of the emerging business models. So thanks everybody for coming to play today. I'm excited about this. Let me start with a question, and I'm going to throw this out to John and Talib first. But we're all going to join into this. I asked everybody, would you come off of mute to stay off mute so we can jump in and finish each other's sentences or redirect as their energy goes. But the first question I'd love to ask you all is, both of your ventures, to what Tracy just talked about, are focusing on ownership of commercial real estate for different target populations, but in communities where there's low wealth communities. I would love for you to say a little bit about why you decided, what was your own personal or company insight about why that was the asset class you wanted to.
Let me know in the comments when it comes between commercial and residential real estate, which one do you more prefer and why?
Focus on, and a little bit about the model that you are offering in the world, like what niche that fits. And John, if you want to go first, and then Talib, come on in, and we'll both just get a little bit of that unpacked for folks on the webinar.
Okay, thanks, Ida. Number one, when we started doing a human-centered design and talking with people in a neighborhood that we were targeting to create this community investment trust, which we didn't call anything then, we called it renter equity. So we focused on talking with renters who weren't by default mechanism paying down a mortgage and building wealth. So we had an instinct that commercial real estate may be motivating, and that's exactly what people told us. So number one was people are motivated by the tangibility and proximity of real estate in their neighborhood. The other one is people building net worth slowly by the default mechanism of paying a mortgage through rent is also compelling. But then the strongest thing was just the mutually reinforcing factors that when a neighborhood, in our case now we have 300 plus investors touching 1,200 people at the family level. When you have those community members patronizing, paying attention to a building, it reinforces the tenants, nonprofit, for-profit tenants, their business model, and also ripples in community effects, relationship building, safety, and connections. So that's the reason for commercial real estate in our case. Talib?
Yeah, so thanks for having me. Mine's very personal, right? So I'm a fourth generation entrepreneur, both on my matriarchal and patriarchal side of my family.
If you happen to own a business, let me know in the comments what type of business you own or what type of business you hope to own.
And I've seen the differences when one family member owned their real estate, both the commercial real estate as well as held residential assets, and the overall outcomes for their family. I'm talking about, being able to pay for your son or daughter to go to college, or giving them down payment contributions for them to buy a house or start a business. Those types of outputs, and understanding the differences is what kind of drives me to do this work. And then specifically about our work at Partners in Equity, if you're familiar with down payment assistance, that's essentially what we are, but we show up as an equity partner. So we place patient, affordable equity capital in the form of down payment for Black business owners to own their commercial real estate. And what makes it patient is the terms that we get into with our business owners, staying in it for 7 to 10 years, the typical life of a commercial mortgage when it's time for them to refinance. And we can get more into the model as we go through the session.
Yeah, that's great. Thank you. There's, as you all know, and as folks on the tuning in will know, we are really taking a deliberative approach at Aspen to thinking about a cohort. There is an emerging set of organizations that are taking a look at the kind of data that Tracy talked about and saying, what are viable business models, scalable business models to address this opportunity? And so you all, in many ways, Partners in Equity and Community Investment Trust, represent two ends of a continuum that we see between, shared ownership, like a full-on business model around shared ownership, and how do you actually kind of scale the opportunities for sole proprietorship as well? So I actually want to kind of flip us to the next question, which would be, say a little bit, Tracy said a little bit about the kind of neighborhood retail that she's focused on. How much does your own focus on real estate mirror what Tracy was talking about or differ? So say a little bit more about the kind of properties that you are working with, intermediating access to in terms of ownership for clients. And I maybe say a little bit more in that same place about what is, somebody said earlier, wealth, Tracy said wealth means many things. When we think about functions of wealth, it can move across the real generational wealth transfer to just the stabilizing functions of wealth. So say a little bit about just a little bit more about the kinds of property and the kinds of wealth creation that you both see and expect for the target populations you're serving. Talib, feel free to go first, or John, doesn't matter.
Go first. So at Partners in Equity, we primarily focus on owner-occupied commercial real estate. So think about that local dentist or that auto repair shop, or think about that last mile delivery service that now, due to changes in logistics, now needs a larger warehouse or a larger place to park their truck and vans. That's where our type of capital shows up for down payment. And then when you think about that business owner, a lot of times the business owner that is really thinking about purchasing their commercial real estate, they might have the 15 or 20% down in dry powder, but that's a lot of their operational capital.
Let me know in the comments if you knew this type of opportunity was out there.
So it's always been very risky for those business owners to take that money they really need for operations to make that leap into ownership. And that's where our patient capital shows up. So we're working with business owners that have typically been in business for at least 3 years, and also have been able to execute on a commercial lease during that time, 3 years to 5 years. And, and at Partners in Equity, we like to say, like, we hate rent, and we really do. Like, I don't even like to rent a hotel room. I wish I could own some of Marriott. I guess I could through stocks. But that's what we really care about, is like working with the business owner. Like, if you've demonstrated that you can pay rent, and we know that the mortgage that you're going to get is typically going to be that amount or less, let's figure out a way to make it get the transaction done to put you in an ownership position.
Thanks.
Let me start by explaining East Portland Community Investment Trust. We launched this 6 years ago on the 1st of November, and it's largely fully subscribed now. And the tenant mix there is a mix of for-profit, nonprofit. I think the tenant curation kind of evolved really through some direction of the investors themselves in the community, telling us what they wanted, what they needed, what was missing. We're working now with Erika's help and JP Morgan Chase with 8 cities around the country doing 2 4-city cohorts. We just wrapped up a convening of the first 4 cities, and they're looking, we put out some mapping tools and some other survey assets that we created when we created the pilot. And I think the different cities are doing that research now to find out what type of property, commercial retail, and how to do a tenant curation that delivers some income and also contributes to the community needs. Most of them are looking at properties similar, I think, to ours, although some of them are older properties, so historic properties, but the cities, ours is a 29,000 square foot, 1962 mid-century modern building, 2 floors, roughly 30 tenants, a mix of nonprofits, for-profits. Other cities, I think, are looking at historic rehabs and a range of modifying 1980s strip malls and tearing them apart and doing a different configuration of that development. So it's super interesting to see the range of opportunities and options that these cities are looking at. And the cities are, help me out, Erika, it's Albany, New York. They have a property, historic property in the first cohort. Albany, New York, Brooklyn, Brownsville and Brooklyn, New Orleans, and Minneapolis along George Floyd Square. That's the first 4. The next 4 that we're just incubating are Detroit, again, with 2 years of support from JP Morgan Chase, Detroit, West Dallas, Tulsa, Oklahoma, and the Seattle metro area. We're looking at Everett, which is north of Seattle. And I think each one's going to have its own characteristic, really just based upon the realities and the market and the target investors they're choosing.
And I'm going to bring Erika in just a sec, and Talib will come back around to this with you later in the conversation. But John, just to the point of this has been now in the works for a number of years, and you actually, when we talked about kind of wealth, I think many of us can understand how direct ownership appreciates back to an owner, both in terms of managing their costs in many ways. Could you describe a little bit of some of the early evidence you have about the way that shared ownership in your model returns to the participants in the model?
Yes, you know, we approach this from a standpoint of targeting renters and first-time investors, women, people of color, people that are left on the margins of being involved in investing. So we call it an on-ramp to financial inclusion and investing. And we've managed to, through connections in the community, really find the kind of investors that we were targeting. And they're super sticky. We were fully subscribed. People have invested about just over 500,000, and net worth of that's about 650,000. So on a financial standpoint, they're getting upside dividend. They're getting dividends every year. That's average 7.9%. Share price has gone from $10 to $19.02. So from a financial perspective, it's worked out great. They're sticky. They take a course called Moving from Owing to Owning. It's a peer-led course about people's relationship with money. People are voting and more active in the neighborhood than they were before becoming an investor. When we ask people, well, why is that? They say, well, I'm an owner now. You know, I've got a bigger stake and role in the neighborhood than I had before. So it activates citizenry and collaboration and relationships is something that we aspire to, but that we're seeing it happen is something that's really one of the, you know, outside the financial side of it, it's a big driver, I think, in how other cities are seeing this as a valuable community development effort. Right, Erika?
Thank you. Yeah, well, I am going to, Erika, why don't you come off of mute? Because I think, John, I know what a long road it's been to make the case and to start to be able to think about, you know, aspirations for other cities and how to help them and just how to grow what you're seeing. Talib, you've got your own challenges there. So Erika, I'd love to invite you in both the kind of what's the reason you decided to become an investor in this work? What's your read on what you hope to learn from that? And, you know, and how closely do you think others are following this? Like, are you alone in the world in terms of some of the philanthropic, that thicker capital stack, or, you know, kind of like, so first off, why you? And then, you know, a little bit about what you think this means for others who might be watching and still on the sidelines. Or
let me know in the comments what made you stand out from the rest.
How we grow that number of people who are thinking about this as a viable area to become involved.
Thanks, Ida. So there have been like 20 points during this conversation where I wanted to jump in, but I've been waiting patiently. And I'll actually start at the back and work my way back to your first question, which is to say, one, I don't think we're alone. And I do think Tracy made a good point in that a lot of times our efforts have been very siloed in thinking about wealth building. While expansive in their own spaces, right? We might be thinking about this from a small business perspective. We might be thinking about this from an individual or household perspective or a home ownership perspective. Like, we haven't had a lot of opportunity to think about the intersections of these spaces in this work, which was what brought us to shared ownership as a learning opportunity, right? Where do we bring neighborhood development, small business expansion, and individual financial health together? And a lot of the models that you're hearing about today are really looking at the intersection of those bodies of work. And I think there are a number of funders out there who are thinking about, like, how do you really propel the efforts forward? And that's at the intersection. So I don't think we're alone. I will shout out Kresge, who has supported some of the work beforehand. I know there are a number of local foundations in the cities that we're talking about expanding to through the CIT effort who are also interested. There are a number of large nonprofit organizations who are also thinking about this more deeply. So we're definitely not alone in this space, but are happily out in front charging forward to make the case. I would also say another Tracy point that really resonated and hit home for the why for us is the point about it being important for people to have what they need. And that's at the resident level, that's at the business level, that's at the neighborhood level as well. And so thinking about wealth as kind of a vehicle to getting people closer and closer to well-being is
Let me know in the comments, what is it that got you stuck that you think you need?
critical. And to the point about, what does the CIT model bring? At the individual level, John, in the course of some of our conversations, kind of offhandedly made the comment that maybe $400 is not wealth in some people's mind, but it's a significant protective factor when you're talking about low to moderate income households, right? And the volatility of their incomes and what they need as a buffer to overcome barriers that might drop them into significant debt, right? And create significant barriers. So as something to push folks into a space of wealth, that is pretty significant. And the other part of that, which I think Talib and John are touching on in terms of what it brings beyond wealth, is a sense of agency. Ownership is important not only in terms of your feelings about civic engagement, but your ability to control your environment, right? And to have some voice in your environment. And I know, especially as business owners, I'm based in New Orleans. I live down the street from Bayou Road, which is a historically Black business district. And the owner of most of that commercial real estate is a Black resident who lives around the corner from that block, right? So she has been able to exercise some agency in who goes into those businesses and who actually is able to stay, right? So as market pressures push on that district, who is able to maintain their business in that space? And that also dictates what we have access to as residents. So I think wealth building, absolutely. We are totally bought in to that as a mechanism and vehicle for advancing overall health and well-being for individuals, like I said, businesses and neighborhoods.
Tell me in the comments, what does wealth building mean to you?
Yeah, and thank you. Well, and thanks for calling out other funders. I do think that it's important to know. And there's the models here. We're going to go into a little bit more detail. I know MacArthur's been big with Chicago Trend, which is another group. Linda Richardson, shout out there. I think Sunderland and others are looking at Local Code, which is another group that and I'm looking at this amazing chat going on. So to Karen, just know that part of our work on commercial real estate is as a wealth innovators cohort. It is very much our goal over the next 6 months or so to be, producing some of the kind of overarching, who's showing up in this space? What are the new models? What are we? And I mean, Eric, I'm going to put it back to you again, in the sense that, both collectively for the practitioners, but also for people who are looking and learning and trying to understand what is the gap in this thicker capital stack? What do we need to do to fill it? How do you size that problem? How do you size the potential returns for communities? we hope to be documenting a lot of that kind of information and making this something that is on a lot of other people's radar screens. So I guess to that one, Erika, to push it back toward you, could you say a little bit more about the kinds of questions that you hope to illuminate? Like, what do you think other people are wanting to learn from the kind of from both Talib and Partners in Equity, but also Community Investment Trust? What are the kinds of things that you think folks are trying to learn about these models?
Let me know in the comments, when it comes to wealth building or generational wealth, what type of things are you wanting or hoping to learn?
To de-risk investment in some ways.
So I was gonna go right there, right? So I think the capital piece is critical. Talib lifted up patient capital. John, the model calls significantly for impact investment, which also happens to be patient, more flexible in terms of terms, right? Like more accommodating to an alternative, like capital stack or investment model. And so I think the question, on our minds is, do we have the infrastructure? Do we have the right capital ecosystem in place to ensure that projects like this can move forward successfully? Is that about expanding what current institutions are doing, or is that about introducing new products and entities into the market? That is a big question for us, right? Tracy said we've attempted to CDFI our way out of this. That has only gotten us so far. So the question in my mind is, do CDFIs need to play an expanded or different role? Do we need to introduce new entities or products into the market? Do we have other institutions that should be doing something differently to fill in those spaces? And then to the point about de-risking, I think we think a lot about like de-risking on the part of the large investors. But I think, what was appealing to us around the CIT model was the de-risking for the residential investors, right? So what does it mean? Like if I'm taking my dollars that are limited and placing them in a community investment, what is my protection as a resident to ensure that I don't lose my money in that investment? And so I think there's a question for us around that as well. And then continuing to measure like the broader impact, what I have thought about in terms of social cohesion and equitable development and anti-displacement, like what impact did these efforts ultimately have on communities long term?
Mm-hmm. Well, let me take that, Erika, back to Talib and John in terms of your own experience with some of the kinds of partners you've needed to bring on board to help facilitate the kinds of work that you're doing. John, in your case, to the point of de-risking, there's a specific vehicle, there's a specific kind of a piece of an insurance construct that you've developed as part of managing risk for the individuals and bringing on financial partners. And Talib, for you, I'd love for you to tell a little bit of a story about what are the kinds of partners you have and what is the gap between how you're accessing partners for your partners in equity now and where that needs to go. John, you can go ahead and start, and whichever one. But if I was clear as mud, I can restate that.
Yes, I'll go first, and I'll try to be swift here.
Okay.
We used a securities exemption from 1933, a federal exemption that allows us to offer a stock offering to low-income unaccredited investors, targeting first-time and poor investors by giving them complete downside risk protection and liquidity. Which seems impossible. It's not impossible. However, later this afternoon, it's getting more hard because we used a direct pay letter of credit from a bank. And we've had this in place now for 6 years, and it has to be in place. It's, do no harm for the investors. They can cash out anytime without losing their money. But the struggle right now is the underlying asset has increased in value. So at a loan to value of 75%, I'm going to be nerdy with the bank stuff here, but we need to maintain that covenant and a debt service coverage. So it's a very strong property. It's performing well, delivering dividends, share price change. But to right size the direct pay letter credit every year as the exposure for the investors if they all cash out tomorrow, that direct pay letter credit as of today is going to be the amount of the underlying mortgage. So you have to put that together. So it's a leveraged property. And without some sort of greater incentive for banks to engage in this kind of a community development effort, I think we need a liquidity fund or some other form of credit protection, or the banks just simply aren't going to do it unless there's an enhanced widening of the Community Reinvestment Act to allow this to be a contingent liability like this to get CRA credit.
All right, hold that thought. That's great. Talib.
Full disclosure, we're currently fundraising. So I don't want to go too far into what our needs are because I don't want to breach any type of rules here. But just our capital stack is made up of foundations, banks, make up our capital stack, and that balances out different type of risk-adjusted capital as we raise money. The partners that we work with are CDCs, CDFIs, regional banks, and kind of deal flow happens for us kind of two ways, right? One is when you stand up an organization saying you're putting patient equity capital for Black business owners, your phone just rings and rings and rings, right? So we have constantly influx of people looking to get capital, but then also through on the B2B side with our banking partners. So that business owner shows up and can be underwritten, but has had that capital gap for down payment. And that's also how it works for us. I mean, what we're really looking for now is more partners that believe in what we believe in. Most recently, we had a bank move us through investment committee to make an investment in it, which will then open up the room for more banks to be able to participate in investing within PI.
Great. So obviously, for those listening from banks, what we want to do, part of what we want to do at Aspen is we crowd in learning questions for some intensive work with a bunch of the innovators, is to know what are the kinds of questions you would need answers to make a case for this kind of work or to explore it more yourselves. So we want to look across a set of stakeholders who would be interested in the kind of innovations that you're hearing about here, and others that we'll be able to put a spotlight on, to make sure that when we produce something that it's really answering the kind of questions that would hopefully crowd in on this space. We have a little bit of time. I know you all have been scanning the questions that are coming in through the chat. It's this huge conversation over there, which is typical for these webinars, but it always cracks me up just how much people are connected with each other. I'm just wondering, both back to you, Erika, but Talib and John, other pieces of your work or the conversation or what you heard from Tracy that you just want to bring into the conversation right now. So I'll give it some space to either answer something that you saw come up in the chat, or just bring in another point I haven't touched on yet before we go to some final closing statements. Talib, go ahead.
So, we talk a lot about, like, I've heard a lot of talk about, like, what are the benefits to the business owner? And one of the benefits that we have immediately seen through our first investments was like the leverage and the power and the autonomy that it creates for that business owner. Like hearing Erika talk about Bayou Road and the fact that African-American business owner owns that property that allows for space to happen the way they want space to happen in their own community. One of our first investments in Durham, North Carolina, was a really strong entrepreneur. It was a strip of retail, and he took what had once been a 3-bay business and had been transformed into one large 3,000 square foot. He took that, turned it back into 3 1,000 square foot spaces, and rinsed them out two of them out at a very affordable rate for businesses that he wants to be place-based in the community, as well as have an office for him. And that was good enough until I was walking downtown a few months after we made the investment and the deal was done, and I saw his name on another building. And it was under construction sign with his name and his phone number on it. So I called him. I said, "Hey man, what's this?" He says, "Oh yeah, I just bought that. We're renovating that too." And I said, "Well, you didn't need any of my money?" He says, "No, I didn't." Right? Because he had already created that equity event for himself, and within 6 months was making additional investments. And for us, that's the sign of a successful investment. And I want to see more and more of that, you know, and I love what John is doing with what Local Code is doing, with Chicago Trend. And I think that this cohort that you all are creating is going to help us all continue to innovate and bring solutions.
And I would say, so, you know, as a part of, yes, I'm a part of the Learning and Insights team, but I would argue that all of our program officers are part of the Learning and Insights team, right? We are making investments for case making. And so, you know, every opportunity there is to better understand what is going to advance kind of the long-term outcomes for communities. We are taking that opportunity to explore that innovation or that solution. I think to Talib's like example of a story, I had an opportunity to visit with the Portland business owners and the space, and to Tracy's transformative big scale term. I think it's hard to really like put a it's hard to quantify the opportunity beyond like experiencing the difference in a space that is owned by people who believe in it, who live in the community, who are invested in seeing it succeed and thrive beyond just the retail space on a webinar, right? Like it's hard to quantify that. And I would argue that the story Talib just gave is like, it is infinite and endless what the opportunity is if we take the initial risk, if we take the initial chance to make the case that actually this can be successful, and it can create communities and environments that are strong and more equitable and, you know, sustaining and thriving, right? I think we are limited in what we are oftentimes limiting ourselves and what the possibility is in balancing out what the risk is. Like the risk oftentimes is so small for what we are actually aiming for, right? We are holding ourselves back.
Well said, Erika. John, I want to throw it to you, and then I'm going to actually come around to some closing remarks here in this. But you just said the thing that I want to push us, Erika, over time to actually try to be able to say how big is the opportunity, but for lack of X, right? So, you know, when I think about, you know, everything we're talking about here is hard. It's transaction by transaction. There's no cookie cutter to, like you, John, you said, all of these properties are going to be different in your replication cities. However, the fundamental toolbox that you're building is there. Similarly, on a lot of prep calls, there was a lot of complementarity between John, how you work, and Talib, how you work, right? There's not just how does each of these models potentially, what's the opportunity horizon for each of your models to make a difference in more and more communities and more lives, but what's the opportunity for collaboration across some of these models that are emerging as we come together. So while I don't expect that we have numbers right now, if there's anything that you would want to say as in a closing remark for now, which again, this is just kind of kicking off a lot of the wealth innovation work we're doing in the space, how big do you see the opportunity for your work? And what do you think it's going to take to achieve it? I'd love to leave that as kind of like a closing thought for you all as we wrap up today.
You know, the demand for replicating the community investment trust, there's a serious legal and financial fidelity that needs to be in place. That the term CIT has become, community investment trust has become widely used, but it really is only done if you do it correctly with respect to downside risk protection, liquidity, et cetera. But the demand for the model is exceeding our capacity to coach and counsel the cities. So we're doing them in cohorts, and we found that to be really efficient and productive for the cities to collaborate with each other. And we're ultimately building a community of practice so that there's a learning engine and a sharing model, so this can scale more rapidly. But in support of that, the base equity capital, which is basically the capital that shifts to the community over time, that ought to be a more compelling ask, I think, to foundations and institutional funders than it's been. Started vetting that. And then clearly getting the banks engaged in getting CRA credit for doing these and accepting some of that risk on the direct pay letter credit is going to be super critical unless we recapitalize with other forms of capital or have a guaranteed reserve fund or something like that. But I think the CRA path, if that were to emerge out of the recent OCC and intergovernmental agency research, I haven't seen what that entails, but I'd love to see that be a component part of what's hopefully on the horizon.
Thanks, John. And we didn't talk much about this, but just to know that there is a policy angle to a lot of what we're going to be trying to learn with you all about what are some of the unlocks that are related to align incentives through policy mechanisms as well. So thank you for mentioning that. Talib, quickly, big opportunity. Where to?
Well, I think one of the big things is there's a little too much paralysis through analysis when it comes down to moving money. The time is always now, and the time oftentimes in the Black community was yesterday. So I want to see money moving much faster. In 2022, commercial real estate as a whole entire asset class was 1.3 trillion. Less than 1% of that went to funds doing work like this. And if we just were to take that 1% to 3%, you're talking about a $13 billion to a $39 billion opportunity. And I think that can happen over the next few years. We just got to move faster.
Great. And Eric, anything final for you?
I will let you close it out on that. Move money faster. That's great.
Yeah, move money faster, but don't break things. I love it. Well, thank you so much. Again, it's just a little bit of a tip of the iceberg of the conversations we are hoping we're going to inspire in many other places through learning even more deeply about the work you're doing and the ways that it's transforming lives and communities. Super excited about what's ahead. We will, this is going to conclude for this year, the Future of Wealth discussion series, but stay tuned as we release the entire slate of discussions we have planned for 2024. And then from the Financial Security Program, the last live conversation, and I think, John, it actually goes back to some of what you just talked about, within our work on a national financial inclusion strategy, and how do you think much more broadly about financial inclusion in the US that is focused on outcomes across a wider range of things than conversations about just a bank account, but everything we're talking about here. December 5th, we'll have a live discussion. It'll be in person and live streamed. So there's information up on the board about that. But I just want to say thank you again to all of you. Thank you to Tracy. Thank you to Joanna. Thanks for spending your time with all of us today, everybody who joined in. We'll see you again soon.
The one thing that I've learned out of all the things that they discussed was the opportunity for growth within this one video. How they are willing to come together, put their own money on the line to help someone that's been in business, as he said, for at least 3 years, to show that you are willing to pay rent and do what needs to be done for at least 3 years. I didn't know this type of opportunity was out there. Let me know in the comments if you did, and also let me know in the comments, what did you gather? What did you learn from this video? Once again, I am not a financial advisor, but I hope you gained something from this video. But as always, don't forget to like, share, watch more videos, and subscribe to the channel.